Hi, in this video we're going to talk about the Infosys FY22 results. What did the results tell us? What was good about the results? And more importantly, what does one important parameter, the attrition of the workforces, tells us? So Infy came out with its results, and generally the results were considered to be reasonably good. They were slightly below expectations for the fourth quarter, but FY22 results on the whole were pretty decent. If you look at the growth rates for the annual numbers, and I will leave aside the quarterly numbers and talk more about the annual numbers here. If you look at the growth rate of the annual numbers, you'll see that revenues grew by about 21%, which is a pretty good growth given that it's a pretty large company, and the sales were about 1 lakh crore in the previous year and they went up to about 1.2 lakh crore this year. The profits grew slightly lower. So the growth in profits you will see is about 14%, and that's because some of the costs went up more as compared to what the revenues went up. And what are these costs that went up? We'll look at a slightly more detailed review of that as we go along. Broadly, the revenue growth was pretty healthy. This was better than what Infosys had guided. The profit growth was reasonably healthy. It's better than what they have seen in the past few years in terms of the growth in numbers. And in general, the company seemed to be doing reasonably well. However, there was one key parameter that was a bit odd, and this was the attrition number. Now, attrition is the number of people who are leaving the company, and Infy reported the attrition rate for the last 12 months at 27.7%. That's nearly 1% in every 4 people leaving the company, right? This is voluntary attrition, so people leaving on their own. Infy in the year added nearly 85,000 freshers. This is the gross number of freshers added. Of course, some people would have left, and so the net addition in the year was about 55,000 odd employees. But the attrition was pretty high. This was also picked up by most of the news media. So most of the news media talked about Infy's employee attrition rate and what was essentially causing it. So we've heard about this term called the Great Resignation, right? People resigning on their own, either resigning because they don't want to kind of pursue their jobs, they've made reasonable amount of money, they are not getting paid enough in the current role, or because they find better opportunities in other companies. So we'll try and dig deeper into what's really happening here and what does this mean for subsequent years when we talk about Infy and their numbers as we go along. Let's look at some of the data points here. If you look at the employee base of Infy, right, over the past many years, last year was a blockbuster year in terms of the number of employees added. See the highlighted numbers here. You'll see 55,000 employees approximately getting added on a net basis, right? Gross numbers would have been higher, than they would have been people who would have left. This took the total workforce numbers to more than 3 lakh at the end of the year. The addition, the net addition, was significantly higher than any of the previous years. If you look at the past 4 or 5 years, the net addition was never higher than 25,000 employees in the year. This year it was almost close to 55,000 that we looked at. In addition, there's another number called the utilization rate, about which I'll explain in a moment, which also kind of went up. Right? Let's talk a little bit about their revenue drivers. Now, how does Infy make money, right? So the revenue for Infy, if I was to kind of create a sort of a quick equation around how do you look at it, is basically dependent on the number of employees, right, into the utilization rate. I will explain this in one moment, into the billing rate that an employee is able to generate on an annual basis. We can also look at billing rate per hour into the number of hours that we are looking at. Now, the way the IT business works is, let's say you have 100 employees who are there on your workforce. Not all of them will be working on a project at any given point of time. The employees who work on a project are typically called the employees who are getting utilized or who are getting billed. So when you say the utilization rate is 82%, this means out of the 100 employees who can be billed, 82 are getting billed, right? So the total number of employees multiplied by the utilization rate multiplied by the billing rates into the number of hours will give me the revenue. Now we already have the revenue that is available with us. We have the number of employees, we have the utilization rate. I can back calculate and find out what is the billing rate. If you try to calculate the billing rate, which is a blended billing rate in USD per hour, using this equation, that works out to be approximately $36 per hour. Right? And this sees a growth of close to about 3% in this year, which is better than the growth we have seen in the past few years in the billing rate. The company seems to be doing well in terms of number of employees that are added. They seem to be doing well in terms of utilization rates that have improved from 80% to 82% this year. And they seem to be doing well in terms of billing rates as well. Billing rates have also gone up. A combination of these three put together, number of employees going up, utilization rate going up, and billing rate going up, gives us a 20% growth in revenue, approximately 3% in terms of the billing rate and about 17 odd percent in terms of the employees getting utilized. So in terms of the volume growth, when we say volume, this is the billing hours that have happened on various projects, which will only grow if the number of projects have increased. That volume growth has been healthy at about 17%, and the billing rate has grown at about 3%, which has then given a 20% revenue growth, right? So that, so far so good. Let's move ahead and talk about what we think is going to be happening with respect to the costs. These here are the costs as a percentage of revenues, right? And we have highlighted that across the years. You'll see the largest cost for them in the top table is essentially the employee cost. That's nearly about 55% of their total revenues that they generate. And then there are other costs which are highlighted. There are a few which we have highlighted for FY22 that are important. The first one, interestingly, is that the employee benefit expense as a percentage of sales has actually gone down, right? That says that they're probably paying lesser this year despite a significant addition. They've added a lot more freshers and probably people have left at an experienced level. So the average salary has not grown as much, right? The salary expense has gone down even though the, as a percentage of sales, even though the number of employees have kind of gone up significantly, kind of tells us that experienced people are leaving, freshers are joining in, right? Then there are two other interesting costs that come up. Cost of technical subcontractors. Now this is essentially when the firm does not necessarily have the requisite talent in-house. They are using contractors to do that work. That has gone up, correct? And the third is cost of software packages and others that has gone up, and that's primarily on account of the fact that people have been working from home, so consequently more software packages etc. could have been used. This number used to be about 3% till FY20. That's become nearly twice of that in the last couple of years. The one benefit they've had over the last 2 years, which may not exist in subsequent years, is the travel expenses as a percentage of sales. That's gone down in the last 2 years, but as the word normalizes, that's probably going to come back again. The bottom table that you see, we take the average number of employees during the year and we divide the salary cost by that to get the employee expenses per employee in lakhs. Here again, last 3 years you see the growth rate has been between 9%, 3%, 2%, but this year the growth rate has been only 0.8%, highlighting either the fact that wage increases on average have been low, or the fact that senior people are leaving and junior people are replacing them in terms of the workforce, and consequently the attrition is having some kind of an impact that may have resulted in higher subcontracting because the requisite skill set was not available. So those costs kind of start going up when you are adding more freshers to the workforce. So that's some of the analysis on the cost front. Now what are the possibilities with this attrition, right? The first possibility is Infy decides that they have to control the attrition. To control the attrition, if the cause is better salaries available elsewhere, which is for example the entire the consumer tech, the fintech, the edtech area where a lot of these new startups are coming up and they are flush with funds, so they're essentially paying good amount of salaries to new engineers who are coming in. Consequently, all the IT services firms in India will also have to go and increase the salary base in order to compete for talent in that market. So in that case, staff cost is going to go up, which is going to be a problem for the margin. The second possibility is if it decides to live with the higher attrition, it says I have enough number of freshers joining me and we're okay with that. They will keep joining us. We have the talent pool that is available. But in that case, some other costs such as let's say hiring would go up. You'll have to train all the new employees consistently, and the cost of subcontractors will also remain high. Either ways, the problem is that with this scenario of higher attrition, it can't be good for margins of the company. The company will have to find a way to either pass on these cost hikes to customers, or margins will remain under pressure in the future. That's a very clear sign that is evident at this point of time in the markets. Let's summarize the results quickly. The positives was good growth in terms of volume, higher employee addition showing visibility of projects in the future, higher utilization, higher billing rates. Almost everything went up, and that resulted in a good growth on volume basis as well as on the revenue basis that eventually came out, 20% revenue growth, and they've guided for about 13 to 15% revenue growth next year as well. The concerns, higher attrition, that could result in costs going up in the future if you want to control the attrition. Other costs went up like technical subcontracting, and travel costs will again start inching up in the times to come. All in all, the results were sort of a mixed bag. On the revenue front, it was good. On the cost front, there were some concerns that are coming up. The bigger concerns will be in the years to follow, purely because this high attrition could create a little bit of a challenge for the companies to retain talent and increase their staff cost as we go along. The stock actually trades at about 30 to 35 times price to earnings ratios on a trailing basis. Technically not very cheap, although it's a great company. Disclaimer, not a recommendation to buy or sell the security, but just a quick understanding of how the results were and what does it mean for the sector going ahead. That's it from me in this particular video. Thank you.